Investing can be a powerful tool for building wealth, but it's also a minefield for those unaware of common pitfalls. Even the best intentions can lead to costly errors that derail your financial goals. Let's break down the top 3 investment mistakes and how to avoid them. 1. Chasing market trends. Jumping on the latest investment trends can be tempting, but it's often a gamble that ends badly. The mistake. Trend-following investors often buy into the hype when prices are already high, only to watch their investments crash when the bubble bursts. The solution. Focus on investments with strong fundamentals and long-term growth potential. Research thoroughly and avoid decisions based on hype or fear of missing out, FOMO. Diversified portfolios built on solid strategies often outperform fad chasing. 2. Failing to diversify. Putting all your money into one stock, sector, or asset class is like gambling. It's risky and rarely pays off. The mistake. Overconcentration means your portfolio's success hinges on a single investment. If it fails, you could lose a significant portion of your wealth. The solution. Spread your investments across various sectors, asset types, stocks, bonds, real estate, and even regions. Diversification reduces risk and increases the chances of stable, long-term growth. 8. Consider low-cost ETFs or index funds to achieve broad exposure. 3. Letting emotions control decisions. Fear and greed are 2 of the biggest obstacles to successful investing. The mistake. Emotional investing can lead to panic selling during downturns, or chasing unrealistic gains during market booms. Both behaviors hurt your portfolio's performance. The solution. Stick to a well-defined investment strategy. Use dollar-cost averaging to invest consistently over time, smoothing out market volatility. Remember, market dips are opportunities for disciplined investors, not reasons to panic. Other mistakes to watch for. Neglecting fees. High management fees or trading costs can eat into your returns over time. Choose low-fee investment options when possible. Overtrading. Frequent buying and selling often leads to unnecessary losses. Long-term investors typically see better returns. Skipping research. Always understand the assets you're investing in. Don't rely solely on hearsay or social media tips. Practical tips for smart investing. Set clear goals. Know whether you're saving for retirement, a house, or financial independence. Build an emergency fund first. Never invest money you might need for immediate expenses. Rebalance regularly. Adjust your portfolio to stay aligned with your goals and risk tolerance. Be patient. The market rewards those who play the long game. Avoiding these common investment mistakes can save you thousands and keep your financial goals on track. Focus on consistency, discipline, and a diversified portfolio to build lasting wealth. Smart investing is less about taking big risks and more about making steady, informed decisions. With time and patience, your investments will grow and set you up for financial success.